Last week, the Bank of Canada released their financial stability report where they outlined the biggest risks to the Canadian economy, and there's something important that not a lot of people are talking about.
Some indicators of financial stress have risen. At the same time, the valuations of some financial assets appear to have become stretched. This could increase the risk of a sharp correction that could generate system-wide stress.
In this new report, the Bank of Canada warns of the way that Canada's two main classes are being treated entirely differently, something I personally think is very unfair, while also warning of a big bet that Canada's wealthy elite are making and how that bet could go wrong, which could risk the chance of economic contagion that could spread across the entire economy, potentially impacting the savings and investments of every single average everyday Canadian. But before we get into this big bet and the risk they're taking, for which we could all feel the consequences, first they outline a concern that applies to every single Canadian a little more directly, even though it doesn't seem fair at all.
We have seen a rise in financial stress. Survey evidence suggests that the stress is more concentrated in renters. In contrast, if you look at mortgage holders, indicators of financial stress actually have changed very little and remain quite low.
You might be thinking, well, that doesn't really make sense. How is it that the people that have taken on hundreds and hundreds of thousands of dollars of debt to buy a home in the form of a mortgage, how is it that they are better off financially than the people who have significantly less debt when it comes to a dollar amount, even though interest rates have gone up so much? Wouldn't you think that the people that have taken on large amounts of debt would be negatively impacted by that increase of interest rates? It turns out that's not the case. Renters are getting a way worse deal in this situation than homeowners are, even though you'd think homeowners might be the most interest rate sensitive in this sort of run-up of interest rates over the past 2 years. We'll get into the extremely unfair reason why this is happening, and believe me, I have some thoughts on it. But first I want to show you that this actually is the case. This chart shows a bunch of different types of credit products, both credit cards as well as auto loans, and compares that between people who have mortgages and people who do not have mortgages, and shows you, okay, of those people, what percentage of them are not paying their loans off anymore, which percentage of loans are in arrears or are delinquent. You can see that over the past 2 years, delinquent loans have ticked up in every single category, but far more so for renters here. We can see these top two lines. This is the credit cards for people without a mortgage. More of them are in arrears, as well as auto loans, and less so for mortgage holders, both for credit cards and for auto loans. So why is it that renters who have taken on less debt and might be more financially responsible as a result of that, how come they're getting the bum end of the stick? Now, first off, and this is a smaller point, the possibility of mortgage holders being able to consolidate their debt is a lot higher. They have access to credit products like HELOCs or home equity lines of credit that are often at lower interest rates than this consumer debt for auto and credit cards. So if you have a mortgage and you maybe have equity in your home, it's likely that if you have this high cost debt, that you would instead take out a home equity line of credit and pay off those higher cost forms of debts, higher interest rate forms of debt, and then just have the HELOC have the balance, which isn't tracked here. So that's one reason that I think renters could be more negatively impacted, is because they just don't have access to the kind of debt consolidation products that homeowners have access to. But primarily, and I think this is the biggest factor, and it's something that kind of pisses me off, it's that time and time again, the government caters to homeowners, providing relief to them when times are tough and letting them see the benefits of appreciation in their home values when times aren't so tough. It's no wonder that Canada has these insane real estate prices when the government policies that we see, especially new ones that we're going to look at in a second, are constantly telling you to borrow more and to stretch yourself to buy as much real estate as you can. And I think this makes my point very clear. This is a section of the recent 2024 budget released just about a month ago from the federal government called the Enhancement to the Canadian Mortgage Charter. Inside of this, they have a lot of rules that are supposed to help mortgage holders out. Time and time again, we've talked on the channel about how big banks are allowing for amortization extensions, essentially extending the amount of time that homeowners have to pay off their loan while also forcing them to pay higher interest, but as a result, reducing the monthly payment so that they can actually make ends meet in the short term. Well, it seems that these amortization extensions that the big banks have been offering, well, they're getting codified in this Canadian mortgage charter. It says it right here, more detailed expectations for lenders to proactively contact borrowers, including making permanent mortgage relief measures available, whereas this was supposed to only be a short-term thing. Now it seems like, hey, maybe we're going to make 30-year, 35-year, 40-year amortizations the norm. Now, this is a good thing in the short term for these homeowners because it'll reduce their monthly payments if they can't make ends meet, but over the long term, like, this really helps out the banks, right? Because even though this solves the short-term problem for homeowners, over the long term, they'll pay far more in interest to whoever's holding the mortgage on their property, whoever's given them the loan. So interesting things to consider there. This gets even more interesting when you consider the big bet that's being made by a bunch of wealthy people in Canada, the one that could put us all at risk here. That's what the Bank of Canada is concerned about. But just to close things up here on this point, all this is to say that mortgage holders have gotten consistent relief. Homeowners have gotten consistent relief when times are tough. The government implements policies to make things easier for them. The same can't be said for renters. There hasn't been a similar sort of relief in terms of rent prices that they're paying, despite the higher cost of living that we're seeing. But ultimately, I don't think that this unfairness is a big concern for the Bank of Canada because they continue to point out that, well, when we actually look at these specific stats, things are better now than they were before the pandemic. Take a look at this chart exactly from the same report we've been talking about. This chart shows how many months of income people have in savings or liquid investments like stocks. And they use this as a measure to say, like, okay, well, how much of a buffer do people have? How many months of runway do they have of income before they would run out of funds? And they show this in three different time periods. The blue ones are from before the pandemic, the yellow is from early 2023, and the green is from early 2024, just recently. And you can see a pretty big discrepancy here. Of course, renters having far less in terms of savings and stocks that could hold them over. Homeowners with a mortgage are in a little bit of a better position, and homeowners that have their house paid outright or homeowners without a mortgage, well, of course, they're in the best situation. But the Bank of Canada uses this data to say, even though there are these discrepancies between the different classes or different types of Canadians, well, actually, for each of these individual classes, they're actually in a better place than they were before the pandemic. Just compare the blue before the pandemic to the green after the pandemic. In all cases, this has gone up, meaning that average Canadians have more in savings and in liquid assets than they did before the pandemic. So they use this to say that, well, Canadians are actually better off than they were before the pandemic. But personally, I don't buy it, and I don't like this chart at all because this is measuring the amount of months of after-tax income people have accessible to them. But what it doesn't account for is for the incredible inflation that we've seen since 2019, and it also doesn't account for the fact that wages haven't kept up with that. So when we're measuring things in months of after-tax income, well, that's not a very good measure compared to how wages have grown significantly less than the cost of living has grown. I don't buy that Canadians are better off now than they were 4 years ago. So that's frustrating, sure, but the biggest risk of all is something that you may not have ever even heard of. You see, Canada's wealthiest individuals, as well as big hedge funds and retirement pension plans, retirement pension funds, well, they're borrowing billions of dollars to make a very big bet. But if things don't go as planned and the bet doesn't hit like they expect it to, the Bank of Canada is saying that this could create an awful situation, not just for these big players, but also for every single average Canadian. But before we get into that, I want to take a second to thank the sponsor of today's video, and that's Crypto.com. I want to start off by saying crypto can be risky and it's definitely not for everyone and you can lose what you put in. But more and more Canadians are including crypto as part of their investment portfolio, and that's myself included. Now, I always recommend dollar cost averaging into a diversified index ETF inside of a tax-free savings account. But if you've already done that and are looking for a way to increase your risk slightly, to increase your potential returns, well then looking at investing a small portion of your investment portfolio into crypto is entirely reasonable. And if you're looking to buy crypto, well then Crypto.com is a solid place to do so. You can fund your account and choose from a selection of over 250 different cryptocurrencies, all with Canadian dollars, but personally, and obviously this isn't tailored financial advice for you, I like to stick to the more tried and true Bitcoin and Ethereum. Additionally, you can also check out their suite of metal prepaid cards with different cashback options, and they also have rebates on subscriptions like Spotify, Netflix, and Amazon Prime. So if you're looking to buy some crypto, make sure to check out Crypto.com and use the referral code RUSS, that's RUSS, or you can just click the link in the description of this video. And thanks again to Crypto.com for making videos like this possible. Now, in the Financial Stability Report, the Bank of Canada said that there's one thing that has the biggest risk of spreading out and creating a sharp downturn in markets, and it all has to do with this big bet that's being made by fund managers, and it could impact everybody. But what exactly are these fund managers betting on? Well, they're betting on interest rates going down. For a while now, it's been the consensus that rates would begin to decline marginally this year. So of course, these firms think, knowing that I believe that to be the case, how can I make some money on it? The answer in their eyes is bonds. As a quick refresher, you'll remember that bonds and interest rates are very tightly linked together. In fact, the prices of bonds have a large impact on what the average interest rates are that you and I pay on any kind of credit that we take out. And as the price of bonds go up, the interest rates that those bonds pay and that we pay in the economy tend to go down. And the inverse is the same. As bond prices go down, while interest rates tend to go up. So if big hedge funds wanted to speculate that interest rates would in fact come down, well then they could make money on that by buying up a bunch of bonds, knowing that, hey, the price of those bonds, well, that's going to go up if interest rates go down. But just buying bonds with the expectation of them going up isn't enough for them. They've also been selling bond derivatives to juice up their profits. Essentially, they're so sure that rates will go down and that bond prices will go up that they're selling something called a futures contract, which oblige them to buy a bond at a certain price in the future for which they get paid a premium for agreeing to do so. Now, we're not going to get into the nitty-gritty of exactly how this trade works, but essentially all you need to remember is that it's another bet that rates will come down and that bond prices will go up. So they're buying bonds and they're selling bond futures, these derivative products. But even that isn't enough because these big players can't make as much money as they'd like from just doing this with their own money. Instead, they've opted to take on billions of dollars of debt to pump up their return while also pumping up the potential risk. They've taken out debt to invest that money that they've borrowed. Now, that can get messy, and just listen to what the governor of the Bank of Canada has to say about it.
We do express some concern that basically the way you make money you don't make very much money on any one trade. There's a small discrepancy. You make a small amount of money. So in order to make this worthwhile, you need to do a lot of it. And to do a lot of it, you need to borrow.
He talks about how this trade only makes a little bit. And to make it worthwhile for these large players, they need to make this trade in size with a lot of money, right? This means borrowing tons of money, which they then funnel into these same bets. Now, this is all fine and dandy when things are going good and the trade's working out for you and things are happening as you expected them to. But if something doesn't go as expected, well, then bad things can happen.
We've seen an increase in borrowing, particularly in repo markets of hedge funds. And in the event that there was a sudden repricing, a sudden change in bond prices, big change in yields, there could be a situation where either because of margin calls or a need to unwind those trades, they could have to sell the bonds into a weak market, and that could really amplify amplify the market swing.
He says that if things go wrong and the trade doesn't work, then the firms taking on this trade could be margin called, meaning that the loan that they took on to invest in this trade becomes immediately due, requiring them to pay it back immediately, right? Now, a lot of the time they're not going to have this money unless their bet pays off, so they'd have to sell their bonds to pay off the loan. The problem is that by selling the bonds, they simultaneously are making matters worse for other people who have taken on the same trade, because the bonds that they thought would go up in value are going down even faster because people have to sell them to pay off the loans that they took on to pay off this debt. And he even does the same motion. It's a cycle, and it can be a spiral downwards in terms of these asset prices, forced selling from people who need to pay back loans.
If you get sharp changes in policy or really unexpected events, it usually affects that sentiment or expectations portion of stretch valuations. And you can get a sharp repricing, and then that's where issues like leverage create a sort of knock-on effect, right? So leverage amplifies a price change. And so back to sort of the earlier comment and the governor's comment just now. So how do you protect against that? You make sure you've got margins or buffers, and you make sure that you're thinking through the potential impacts of those changes, and that you're prepared if you get that large swing in price.
She says that if there's a sharp change in government policy or an unexpected event where rates end up going up instead of down, maybe inflation comes back and everyone's wrong about the way that interest rates are going to go, well, then everyone who bet on those interest rates going down could be in a situation where the leverage in the system or the borrowing that's gone on, well, that could result in an amplified crash of asset valuations. And she says, hey, you can account for this. You can make this less risky by maybe holding more cash reserves, but they're kind of just trusting the people that are making these bets to do so and aren't really monitoring whether or not they have the means to pay off these loans in a worst case scenario. You might be thinking, well, Russell, why should I care about this? I'm not invested in any bonds. This isn't going to impact me. Maybe I have a small stock investment portfolio and I'm doing what a lot of people are doing, investing in index ETFs, so I'm diversified. Well, how is this going to impact me? Well, the situation that I talk about with this downward spiral where firms have to forcibly sell bonds into the market, well, the result will be that some people who have taken on this trade won't be able to sell enough bonds to pay off their loans. And as a result, they could end up selling other assets that they hold to pay off these margin calls, pay off these debts that they've taken on. Now, if they largely start to sell off other assets, well, then that could cause those assets to go down as well, the stocks and companies that maybe you or I are invested in. So as a result of these hedge funds and these pension plan investment funds making these giant bets on something that they think is a sure thing, well, they're actually taking on a lot of risk for average Canadians if this plays out how the Bank of Canada is saying it could. The risk of a steep downturn is even more so if the Bank of Canada is right about what they're saying in this section of the report about asset valuations, the prices of different stocks and different assets in the market. They say that the valuations or the prices of them appear to have become stretched or too high is what the Bank of Canada is saying here, which increases the risk of a sharp correction downward that can generate system-wide stress. The recent rise in leverage in the non-bank financial intermediation sector, that's exactly what we just talked about, could amplify the effects of such a correction. But this is something that I'm really curious about because constantly in this report, the Bank of Canada is talking about how asset valuations are stretched, but they aren't really showing any data for why they think prices are too high. They just say, hey, prices are too high on a bunch of different assets, but they're not really comparing them to any other metrics that are showing, hey, asset valuations are higher than we think they should be. It seems like this is just their opinion that asset valuations are stretched or are too high. And it makes you wonder, okay, why are they saying asset valuations are too high? I think that this could just be a form of forward guidance, a tool that the Bank of Canada uses to try to manipulate the economy, trying to get the economy to do what it wants. By talking about asset prices being stretched or being too high, I think that they're trying to discourage more people taking on these risky bets, thinking that, hey, there actually is a greater chance that this could not pan out how we expect it to, because the Bank of Canada is talking about these high asset prices. But yeah, I think that this is more a messaging thing from the Bank of Canada than anything backed up by data, at least in what I could find in this report. So we've talked at length about the impact this could have on average Canadians. So what should you do about it? Well, unfortunately, I don't think that you should do anything about it. Ultimately, nobody has a crystal ball. This is a report on what could happen if things go wrong, but nobody knows what's going to happen in the future, and trying to time the market, in my opinion, is kind of stupid, right? And if you could time the market directly, then you would be the best financial manager in the world, and you'd already be a millionaire, right, if you knew what the market was going to do. So I say, continue to dollar cost average in with any extra expendable income that you have, because over the long term, over the 10 years, over the 20-year time horizons, well, these sharp corrections that we talk about today, well, they're not going to mean that much over the long term, right? So as long as you don't need the money today, well, then I think continue to dollar cost average into a diversified basket of index ETFs inside of your tax-free savings account or RRSP, where you can take advantage of the tax savings that those accounts afford to you. All that, of course, is not tailored financial advice for you and just a place for you to start and do your own research. But yeah, I think that this stuff is super interesting, and it's interesting to me that the Bank of Canada is even bringing this up because nobody was talking about this. So maybe they think this is a bigger risk that we should be talking about, and I guess now we are. What do you think of it? Do you think it's an overstated risk, or do you think that these bets that the wealthy elite of Canada are making put too much at risk for average everyday Canadians? Let me know down in the comments what you think. What have I gotten right? What have I gotten wrong? I'm trying to learn just as much as anybody, so let me know down in the comments what you think about that. Check out the links in the description, and with all that said, thanks so much for watching this video. I hope it helped you out at least a little bit, and I'll see you next time.